This video covers Learning Objective 7, Evaluate Liquidity using 3 new ratios in Chapter 5, Receivables and Revenue. So let's get started. We are going to talk now about 3 ratios to evaluate liquidity. The ratios are 1. Quick or acid test ratio, 2. Accounts receivable turnover ratio, 3. Days sales outstanding, DSO. The current ratio measures an organization's ability to pay its current liabilities with its current assets. A more stringent measure of the ability to pay current liabilities is the quick ratio or acid test ratio. The quick ratio measures a company's ability to pay its current liabilities with its shorter-term assets, cash and other current assets that are only one step away from cash, marketable securities, and net receivables. The higher the quick ratio, the easier it is to pay an organization's current liabilities. A benchmark for the quick ratio is 1-to-1, which means that the company can cover every dollar's worth of current liabilities by cashing in its quick assets. Normally, one would want to see a quick ratio of greater than 0.9 or 1.0, although it can vary depending on the industry. The accounts receivable turnover ratio shows the number of times per year a company completely collects its average accounts receivable. The accounts receivable turnover ratio indicates how effective a company is at collecting cash from customers that bought products on credit. The ratio does so by measuring the company's ratio of net credit sales to its average net accounts receivable. The result is expressed as a decimal fraction. A larger number is better than a smaller number for this ratio. Once the ratio turnover is computed, it is converted to the days sales outstanding, DSO ratio, by dividing it into 365 days per year. For DSO, shorter is better because it shows that cash is coming in quickly. Notice that a high turnover translates into a smaller number for DSO, and low turnover translates to a larger number for DSO. Now let's go through a set of ratio calculations to measure the liquidity of a fictitious company, Wright Industries. Wright Industries had the balances in its current assets as of December 31st, 2018 as listed on the slide. Its beginning of year net receivables balance is also noted. The formula for the quick ratio is to take cash plus short-term investments plus receivables divided by total current liabilities. For the company in this example, its quick ratio calculates to be 1.10, which is an acceptable quick ratio. Now let's calculate the company's accounts receivable turnover using the same set of data. The formula for accounts receivable turnover is net credit sales divided by average net accounts receivable. A side note about average net accounts receivable. If you are not given the average net accounts receivable, you will have to calculate it by taking the beginning of year net receivables and adding the end of year receivables and dividing that total by 2 to get the average. Here, the company has an accounts receivable turnover of 10.0 times, which means it turned over its accounts receivable 10 times throughout the year. This measure will vary by industry. Usually, the higher the better for this ratio. Finally, let's calculate the days sales outstanding. The formula is 365 divided by the accounts receivable turnover. We just calculated the accounts receivable turnover in the last slide, so we know it is 10.0. Our days sales outstanding will then be 365 divided by 10, or 36.5 days. This 36.5 days means that on average it takes this company 36.5 days to collect its accounts receivable, which does not seem too bad on its own if their terms are net 30 days or something similar to that. To truly evaluate this ratio, we would need to see more years of data to be able to calculate over time and maybe some peer group averages as well. Now we have a few knowledge check questions coming up to test your understanding of this material. After I read the question, pause the video and try to answer it. Once you restart the video, I will be walking through the answer for the question. Let's go. The first question reads, when compared to the current ratio, the quick ratio is a less stringent measure of a company's ability to pay its current liabilities. Is this statement true or false? The answer is false. The quick ratio is a more stringent measure of a company's ability to pay its current liabilities than the current ratio. The second question reads, a measure of the ability of an organization to pay all of its current liabilities if they came due immediately is the choices are current ratio, quick ratio, accounts receivable turnover, or days sales outstanding. The answer is quick ratio. The quick ratio is a measure of the ability of an organization to pay all of its current liabilities if they came due immediately. That concludes our review of evaluating liquidity using 3 new ratios. Thanks for watching.